Good evening, all. ASK Investment Managers welcomes you to the quarterly connect with the portfolio managers. Today, we have with us Sumit Jain, who's a Deputy Chief Investment Officer. Sumit has about 19 years of experience in the Indian equity markets. He was he was actively involved in the conceptualization of the Indian entrepreneur strategy and currently manages the IEP, which has an AUM of over 2.5 billion USD. He also oversees other investment strategies at ASK Investment Managers. He's been instrumental in building the proprietary valuation models at ASK. In the past, Sumit has worked with ICICI Prudential Life Insurance and First Global Securities. He is a postgraduate from Mumbai University and joined ASK in October 2005. Over to Sumit to update us on Indian entrepreneur portfolio.
Thank you, Rahul. Rahul, is my voice audible?
Yes, Sumit.
Sure. Dear friends, welcome to this quarterly webinar on Indian entrepreneur portfolio. What I intend doing this time is, while today has been a great day, so we'll take you through what does this mean for markets, what has been the global backdrop against which markets have been operating. Also, we have recently seen the corporate performances. So we'll take you through what are the sectors, how each sectors have performed, what has been the positioning of ASK, and over a long period, how do we see our portfolios kind of playing out. So let me take you through what has been the macro backdrop. Today, markets were up about 3 to 4%, depending on what index we are looking at. In fact, PSU indices are up significantly more than that. Clearly, this is the event that has happened. The exit polls, they clearly are hinting at continuing power at the center. And this leads to a very stable and fiscal policy expectation, right? There is a hope that government will continue its path on investments. Also, will continue to focus on overall macros as well, because this investments actually activity that we have seen in the economy, this activity has not been without, or rather this activity has been with very high fiscal prudence. GDP growth for FY24 has been close to about 8.2%. This is on the back of 7% growth that we saw in FY23. Inflation also has been under control. So clearly markets have been responding to this solid macro backdrop. And even when we look at quarterly performance, Nifty earnings grew at 26% in fiscal year 24. And we expect earnings to grow. While rate of growth may slow down, we still expect a healthy 13 to 15% growth in earnings in FY25 and 26. So this has been the Indian macro backdrop. But interestingly, if one looks at it globally, there has always been a debate of how fast, how much higher, when would interest rate start to kind of change course. So it's like kabhi khushi kabhi gham moment. At times one believes that interest rates will go down quickly. At times one believes that it is going to take longer. Having said that, we really believe that peak interest rates are in sight. And this has a high implication on growth asset class. Those businesses where relatively higher growth is coming from significantly longer dated cash flows, those businesses would actually see relatively higher positive impact if interest rate starts to correct. Having said that, our expectation is interest rates have peaked out, and we should start to see interest rates kind of going down eventually. Really difficult to comment whether this necessarily happens in the short period of time, but directionally, we would believe that it's only a matter of time. Also, markets globally, not only in India, but globally have been very strong. And this has been in spite of the fact that geopolitically things have not been great. Commodity prices have been fluctuating. Quite a few commodities are uh, have inched up pretty sharply, and also freight costs have gone up globally. So while India has done well, macro worries are not high. Even on the continuation of these policies, we are not worried. But markets globally have actually been doing all right. Now let us go through how the quarterly earnings have been. In general, um, revenue growth for Nifty has been close to about 7%. Profits have been close to about 12%. What has done well? Largely auto, I would say domestic cyclicals, businesses like automobile, real estate, capex driven businesses, BFSI, they have continued with their strong earnings growth trajectory, while businesses which are more globally linked, businesses which are pertaining to energy, businesses that are pertaining to metals, or even IT, actually they face challenges. Let us now get into some of these sectors, if not all. How has auto performed? Clearly, the performance of auto space has been very strong. Not only did OEMs did well, but even quite a few of ancillaries actually had a very solid performance. Margins too have been very, very strong. Interestingly, when we look at the mix, premium side of the market actually has grown much better than the entry level. That has had some impact on margins for the space, for the sector. So there has been tailwind with respect to mix. There has been tailwind with respect to commodity prices. So quite a few OEMs actually retained this benefit. So how do we see scenario playing out for the space in FY25? We believe that two-wheeler space is in a good momentum, and that momentum should continue. Um, Even at the current point in time, two-wheeler industry volumes are still significantly lower than what we saw the peak volumes in the past. So we believe that two-wheeler businesses should continue to do well. PVs and CVs, passenger vehicles and commercial vehicles, should have a flattish first half. And then I believe that CV cycle should start to come back. So CVs is going to be more second half kind of story versus two-wheelers, which should continue to perform really well. We at portfolio level have a pretty decent exposure in the auto space, and we'll continue to look for additional opportunities here. We believe that the way income levels are increasing, the way infrastructure activity is playing out, the way demand buoyancy is there, we are still not back to earlier highs. There is still scope for continued momentum in the space. Let us now move on to very interesting area, which is finance. This is a very large part of the benchmark, um, it, anywhere between 25 to 30%. While banks in general have reported decent earnings, their net interest incomes have been either in line or better. We really believe that yields may inch up as whatever lending that has been done in last 1.5 years, that will start to contribute to yields as well. But funding cost will keep going up. Retail deposit continues to remain challenge especially at an appropriate pricing. So to that extent, we believe that it's overall AUM growth, overall lending growth may still be all right, but NIMs may continue to be watched out for. Overall book, overall credit in India in corporate is growing close to 15-16%, and that is something in an era where large corporates are still not aggressively kind of borrowing. So we really believe that anywhere between 13 to 15% kind of credit growth is something that can continue. However, in spite of this growth, we are still underweight banks. In fact, on the contrary, we are relatively overweight NBFCs as compared to banks in our portfolios. We believe that NBFCs are still better placed. We expect asset quality to continue to get better for most of these NBFCs while it's still decent at the current point. Margins should bottom out shortly, and over period as these NBFCs kind of continue to grow at a rate faster than many of these banks, overall value creation here can be pretty decent. Coming to areas which are some of these areas which are chemicals or consumer durables, there are very interesting aspect that's playing out. When we look at chemicals, this space is witnessing challenging times after a length of time. For a while, many of the chemical businesses have done really well. However, with Chinese destocking and pricing pressure that is being witnessed, the challenges for this space are significant at the current point in time, especially those businesses which are catering to offshore market, which are catering to the international market. Managements are hopeful that possibly from the second half of this fiscal, there should be some recovery. However, we still need to kind of watch out for the recovery trends here. And if you look at our positioning over last few quarters, our positioning here has actually been reduced. We just have one name with respect to chemicals, and there we have kind of seen a very solid performance continuing. With respect to consumer durable and electrical products, it's very interesting. Summer product sales are pretty solid. When we look at room air conditioning companies, their volume growth has been superlative. Even those businesses which are more related to electrical products, cable and wires, those businesses have reported, or rather have been continuing to report, very healthy performance. We believe that the way infrastructure activity is playing out, this is a quasi-infrastructure play. As and when we see activity, there is going to be significantly higher demand for cables. Not only is demand for cables pretty decent in India, globally, demand of infrastructure cables is pretty healthy. When we look at areas like renewable, or when we look at areas with respect to any other infrastructure activity, demand activity is pretty decent. So many of these companies are showing pretty decent growth domestically and internationally as well. And capacity build-up in this space takes time. While in general, physical capacity can come in the short period of time, but overall, when one looks at capacity with respect to all the approvals, it does take some amount of time to come up with those capacities. Let us now move on to more with respect to consumption area. In case of staples, interestingly, the slowdown that we were witnessing for a while has bottomed out. Many of the commentary that we are hearing or demand trends that we are seeing is that rural has stabilized at the lows. In fact, there is an expectation that given the La Nina condition that we are witnessing, possibly rural demand may see a recovery. So that's on staple space. In fact, what we are seeing is there is some amount of change in the overall consumption patterns in the country. Tourism, for example, is continuing to see very solid demand trends. Whether it is aviation, whether it is hospitalities, or whether it is even those businesses which are within this value chain, like OTAs or travel agents, they are kind of seeing solid demand. Margins for these businesses are all-time highs as well. In fact, we really believe that that given the huge focus on infra creation and the way consumption patterns are also changing, experiences is playing a very important role. The long-term outlook or medium-term outlook for these businesses is pretty interesting. Coming to businesses which are software or pharma. Software businesses continue to remain impacted. While the expectation there has been low, they fell short of even those subdued expectations. In fact, so much so that top 5 companies added just $1.4 billion in incremental revenues in FY24. This is kind of closer to about 2% growth. The outlook for FY25 was also seems to be not of a very high growth. In fact, for companies, what's happening is margin maintenance is actually taking a priority. When one looks at overall demand, clients still are slightly cautious. In fact, discretionary spends are under pressure. Anything which is more about cost curtailment are seeing relatively higher growth. So businesses or projects which have relatively higher ROI in the short period of time is seeing growth. But what's also happening is leakages in software services is very high, and which is leading to some bit impact on these businesses. Overall order inflow growth may have been decent, but given the fact that existing projects are kind of scaled down or kind of being put on hold or kind of increased in terms of timelines, we are seeing this kind of impact. We continue to remain underweight in this space so far, and we'll continue to monitor this space very closely for any improvement if there are. Coming to pharmaceutical, this is an area where we believe US generic space is kind of seeing improvement after a length of time. The space actually peaked out in around 2015. Post that, the price erosion actually has been very high. Now what we are seeing is price erosion has reduced pretty dramatically. In few cases, it has kind of reduced very sharply. So while this has implication on revenue growth, this has a relatively higher implication on margins as well. So that's on international pharma, but on the domestic side, most of the businesses continue to remain or continue to perform really well. Even those businesses which are more with respect to API or custom synthesis, that space is also seeing some bit improvement. We continue to remain pretty significantly invested in this space. In fact, on the contrary, we over last few quarters, we have increased our allocation in this area. So how do we see kind of markets playing out? Clearly, the positivism is high. Performance of it, and this positivism actually stemming from two factors. One, macro is favoring, and also on micro front, performance of companies has actually been pretty decent. When we look at FY25, markets obviously need to kind of fight few challenges as well. Geopolitical challenge. We really need to look out for if this kind of creates any impact. Similarly, relatively slowing earnings growth. From 20% plus earnings growth in FY24, we should be closer to about 13 to 15% earnings growth in FY25. On the valuation front, while markets may look seemingly expensive, but they are function of long period growth, confidence on that growth, and also the kind of efficiency that these businesses are witnessing. I believe there is a huge confidence on each of these areas. So to that extent, we are not too much worried of seemingly high valuations in the market at the current point in time. In fact, we really believe that the capex cycle, which has been started by government, should slowly start to creep in private sector as well. At the current juncture, relatively faster growth is being witnessed on public capex. Over period, we should start to see a lot of businesses which are with respect to private side should start to do well. Similarly, on the consumption side, as we just discussed, the onset of La Nina condition actually can boost farm income, and that can lead to rural recovery as well. So over period, we should see both the engines firing relatively well. CapEx should do well. Similarly, consumption should also start to kind of recover a bit. We continue to remain pretty positive on premium consumption as income level keep increasing. There is a significantly higher under penetration in many of these areas. Also, the way consumption patterns are changing, we really believe that premium consumption should actually start to do a lot better. So how has we have always, in fact, when we look at flows, domestically flows have been really strong. However, when we look at flows from offshore side, while calendar year 23 saw close to about $21 billion of flows, calendar year till date has seen outflow close to about $3 billion. We really believe that over long period, we should see pretty decent flows domestically and offshore as well. Given the fact that India continues to remain one of the fastest large economies in the world, and under allocation to India still remains high, right? So as India keeps increasing in terms of its percentage share of world GDP, we should start to see flows also getting better. Now let me take you through how has the performance of portfolio companies been. If I look at the quarter gone by, overall, when I look at revenue growth for the portfolio company versus Nifty 50, revenues grew at 17% versus 7% for Nifty 50. PAT growth is also way superior, 21% versus 12%. While this is for the quarter gone by, the interesting part is for FY25 and FY26 as well, we believe that our profit growth is expected to be significantly superior than what it is for Nifty 50 businesses. In fact, what gives us significantly higher confidence is this growth in profits actually is backed by very superior revenue growth and thereby profit compounding, which is very important because we believe that most of our businesses have ability to increase market share across varied business environment. And that's vital because it is important that businesses keep increasing their relevance in the overall schema, and which is why we believe that the higher revenue growth is of significant importance. Coming to what are the actions that we have taken by and large in the portfolio in this calendar year till date. Overall, we have exited out of 3 names from the portfolio, Page Industries, Havels and Avenue Supermart. While we have kind of bought into 4 new names in the portfolio. Polycab, Sun Pharmaceutical, Adani Port, and Carborundum Universal. One, or rather, Polycab is more about cable wires, beneficiary of the capex cycle that we are witnessing in the country. Similarly, Adani Port is also executing really well as we see Exim improving. Their dominance should lead to very superior revenue and profit compounding. In fact, we really believe that profit growth will be higher than revenue growth in this case as we start to see operating leverage playing out. And also, I mean, while operating profit will grow at a rate faster than revenue, PBT or PAT will grow faster than operating profit because as those cash flows will be used to repay debt, wherein debt or interest or depreciation will grow at a rate lower than profit growth. Similarly, Carborundum Universal again is a beneficiary of the manufacturing. In fact, it's a coincident indicator of manufacturing space in the country. Now let me take you through how is the positioning of portfolio, how has it changed over last 1 year. Clearly, the ones that are marked in red are the ones where we have reduced our positioning. So for example, our financial exposure has come down from close to about 27.6% to 20.4. Overall, we have reduced weight in NBFCs, bank and insurance, all the three areas. Similarly, consumption, as we talked about, Page has been reduced, Havels has been reduced. While we may be positive about those businesses, but we really believe the changes that we have brought about should incrementally add value to the portfolio. What has been increased over last few years, or last 1 year rather? If you look at infrastructure and engineering, allocation has increased from 8.8% to 16.7%. Utilities have moved up. Manufacturing-led businesses have also kind of moved up. Even automobiles have seen increase in allocation. And these are areas where, in general, profit growth have been relatively superior versus market as a whole. When we look at technology and telecom, there is a huge divergence in our positioning versus what it is for the market. We are relatively higher, or rather we have a higher weight on telecom. Benchmark would be about 2.7, while we are about 8% there. Versus software services business, where we have a significantly lower weight. So which is why, while on technology and telecom, it may look almost similar versus the benchmark, even though our investing style is not basis what the benchmark is, it's really bottom up. This is just to showcase how the drift has been in the portfolio. So net increased allocation towards infrastructure, healthcare, autos, each of these areas have been performing really well on the business front, and reduced allocation in financials and consumptions. How does the overall portfolio psychographics look like? See, when we look at earnings growth, we really expect our portfolio companies to deliver 25% and 20% plus earnings growth in 25 and 26, against Nifty 50 kind of delivering 13 to 15% earnings growth. So way superior as compared to what it is for the benchmark. Similarly, when I look at how is the capital efficiency of the portfolio, ROC at 40% plus in both the years is giving us huge confidence about the kind of, or rather huge confidence about the quality of businesses that are there in the portfolio. So this is superior quality portfolio backed by very superior earnings growth. In fact, earnings growth not necessarily in the short period, but we really believe that superior earnings growth from this kind of businesses over long period can also be expected. Coming to the performance, when I look at performance, last 3 years have not been great from the performance perspective. But when I look at FY24, let's say, what has been happening in the marketplace is huge divergence in performance of different ownership patterns. In general, PSU-owned businesses are close to about 12% of the benchmark, and their performance has been superlative. This is a portfolio which focuses on entrepreneur-owned businesses, and when the performance divergence across ownership pattern is large, at that point, we tend to see this kind of impact. Having said that, over long period, we have confidence on entrepreneurs' ability to deliver superior long period compounding. That confidence remains reasonably high. And we remain pretty confident of how earnings growth will play out, how capital efficiency will play out, and thereby how value creation in the portfolio should be happening. I'm open to questions.
Thank you, Sumit. Eventful day, markets at all-time high, Nifty, Sensex, Bank Nifty. We have a couple of questions. Markets at all-time high, but our portfolio returns are not commensurating. Your views on that to start with?
Yes, you are right. Markets are all-time high. While if you look at our performance in fiscal year 24, On an absolute basis, portfolio delivered 32% returns. While we may have trailed benchmark, on an absolute basis, this is still a healthy return. And as I talked about, the fact that relative returns has been a challenge, and it has been challenged more because of the relative divergence in performance that we saw in last fiscal year. Right? And I also talked about how earnings growth will play out, and which is why I would believe that this is a phase where divergence may have been high, but we remain very confident of reducing this divergence over period.
Thank you, Sumit. Can you tell us, there are about 7 stocks that we added last year, FY 23-24, and this has been one among the highest changes that we have had in IEP in the recent times in terms of number of stocks. How has their movement been? If you could name the stocks, or if I could start with IndusInd, we possibly entered in May 23. What was the logic of entering into IndusInd Bank, or what thoughts were running to get into IndusInd Bank to start with?
First of all, if you look at our portfolio positioning, in the banking space, we just have 2 names in the portfolio, one among them being IndusInd. Right? We do not have any other banking name in the portfolio. So our positioning is significantly lower in banking space. When I look at IndusInd per se, overall, the expectation is that with the kind of execution that we are witnessing there, the kind of leverage that that bank has, ROE in potential of increasing ROE is high. So if you remember, we had IndusInd in our portfolio at one point in time. We exited out of that name, given the fact that we expected their asset quality to deteriorate. I believe most of those challenges for the bank actually are behind. And we are back to a reasonable growth. We are back to a point where overall AUM growth is decent. NIMs are not under significant pressure. ROE growth will be decent. And consequently, our profit growth is going to be decent, and overall ROE should improve. And that was our thought at that point in time, and which is why we entered that name. In fact, even on the valuation front, it was pretty interesting. Right? Overall, we have still made reasonable money there, and we continue to remain pretty positive on this name.
Okay, to continue on, Dr. Reddy's was added in June 23. Maybe the entry point was about 4,500, and today we are at about 63, 6,400. Your thoughts on the stock when nobody was actually adding pharma in their portfolio? What made us buy in pharma stock in our IEP?
So see, Reddy's per se has multiple growth levers. While I talked about how US generic cycle is also kind of evolving, but that's not the entire story for Reddy's. While obviously it remains a pretty dominant piece for Reddy's, but I believe not only will US for them should do well, even India piece has a significantly higher leverage possible for them. They have been, in a way, not a large player in the country, but their focus in India has actually increased pretty dramatically. They would get into OTC, they would get into in-licensing products. Right? So we really believe that India should be a significantly larger piece for them over period. Also, when this company was undergoing, or rather when industry itself was undergoing a significantly difficult phase, they never stopped investing into the business. They continued R&D investments, and which is why some or the other product which are relatively high margin will keep coming up. So they have Horizon 1 investment, Horizon 2 investments. Horizon 1 investments are for shorter period. Horizon 2 investments are more about longer term, right? So, multiple growth levers, continued investment, and even when all this was happening in the backdrop of a difficult industry environment, their margins and their ROC still were not impacted. That talks about the strength of the organization. Also, they were the first one, or they were among a few people who could get their facilities pretty clear from US FDA. Right? That also talks about the culture or about the process improvement that the company has brought about. So, our thought was very simple. Growth levers are many, and that growth levers are backed by continued investments. So we thought superlative profit growth and improvement in ROC balance sheet was significantly healthier. Over period, they became net cash companies. So acquisition-led growth was also possible for them, and which is why we kind of entered this name. And we continue to remain pretty positive on their business performance.
Thank you, Sumit. Sumit, on a benchmark BSE 500 weightage of the healthcare sector at about 5.5%, we are at about 15% with over four names: Sun Pharma, Divi's, Dr. Reddy's, and Torrent Pharma. This segment or this sector is currently not moving ahead or not seen much of the positive side. Your thoughts on this sector?
Yeah.
And why are we holding a large component against the divergence from BSE 500? Is it to take care in case of a drawdown of the markets? In any understanding?
So, see, first of all, let me talk about our philosophy. We generally would not take a bet taking a view on markets. Our investing style is really bottom up. Only when we like a business, we would get into it. And as I talked about the fact that this is area where we believe cycles are changing. Right? And which is why we have a whole host of stocks. Something like Torrent Pharma, which is a play on domestic space. They are very solid in their execution. In fact, if you look at their profit compounding over last so many years, they have been one of the better ones. And not only is profit compounding superior, it is actually backed by very superior India business ROC as well. Their focus is, in a way, India operations. In fact, if India and Brazil operation, which is a branded generic market, if I look at their incremental ROC in India and Brazil business, that is as high as 50% or more. Right? Very few businesses actually can deliver that kind of incremental ROC. So, I would call Torrent as execution champions in India business, and which is why that's a part of the portfolio. Similarly, Dr. Reddy's or Sun Pharma are, in fact, Sun Pharma is a name which has pivoted from pure generic to a very dominant specialty business in US, and we really believe that now is a point where we should start to see their, pretty decent improvement in profitability of their specialty business. They've invested big time in specialty over last so many years. Probably time has come to reap those benefits of the investments that we've seen. We discussed about Reddy's, and another name in the portfolio is Divi's as well. And here Divi's was impacted initially because of lagged impact of COVID on the R&D budgets. Those are slowly kind of turning around. In fact, this quarter was a very decent profit surprise from Divi's. So very confident of how earnings trajectory will play out. So if you look at areas that we are positive on, pharmaceutical is one area where we remain positive on. Infrastructure, engineering, manufacturing oriented businesses, is area where we are really positive on. This is area where we have increased allocation. And when that area does well, I think the whole ecosystem actually starts to do well. And the whole ecosystem of capital goods, ecosystem of consumables, and if you look at our portfolio, we have a pretty decent exposure towards consumables name. I mean, whether you want to call Carborundum as a consumable company, or even Cable Wire Go as a quasi infrastructure play, or even APL Apollo, which actually benefits really benefits when we see significantly higher infrastructure activity. So that is another area where we are positive on. Premium consumption is third area where we are kind of positive on, and autos as
To continue on, Sumit, Interglobe Aviation was entered last year in September. With currently the airline segment facing a lot of customer issues, what made you bet on Interglobe Aviation, and where do you see this segment? Because worldwide, people don't see returns coming on airline sector. What is the thought here?
You are right. If one were to add up profits of all the airlines globally over last many years, number would either be zero or a number which is not even worth discussing. So clearly, Indigo has been one of a company which has belied those thought process, right? What is it that we liked in the company? First, let me take you through the micro backdrop, and then we'll take you through the macro backdrop. If they are cost champions, they have kind of standardized multiple things. If you look at their fleet, it is largely Airbus aircraft with a very standard single aisle aircraft, right? So standardized multiple things, which led to significant reduction in their cost structure. And today, clearly in India, for sure, and globally as well, their cost structure is one of the lowest. And this is an industry where cost structure plays a very important role. Not only is there internal cost structure, cost of delivering one seat per kilometer, one of the lowest, but if I look at their cost of procurement of aircrafts as well, that's also very competitive. They do, given the strength of their balance sheet, they can order in bulk, which gives them ability to kind of ask for higher discounts. And in an era where even this cost of capital is going up, their cost of owning an aircraft versus second player, actually that gap is widening. So to that extent, this industry itself is seeing entry barriers increasing. Cost of entry of a new player has also increased pretty significantly. And when I look at macro backdrop in India, overall, I believe the industry will continue to grow. As we talked about changing consumption patterns so to that extent, industry growth is expected, and he is one of the lowest cost player in the industry, right? So which is why our confidence on their ability to deliver reasonable profit growth for a length of time is higher. In fact, if one look at their overall profitability, and when I say profitability, let's say revenue that they get by flying one passenger per kilometer, and fuel cost that they incur for the same, because fuel cost is a very important element, and over last 10 years, in INR terms, fuel cost has gone 3x. Even in this kind of environment, they have increased their profit, their contribution profit. So you know, their ability to kind of increase profit even in such kind of environment gave us confidence that here is a company which is in a way last man standing. Industry tailwind is high. And the kind of infrastructure built out, number of airports that we are seeing, we thought that macro backdrop is recent and so is micro backdrop, and which is why we remain invested in this name. In fact, if you look at our positioning, this is a pretty large holding for us.
Thank you, Sumit. Your thoughts on AU Small Finance Bank? I think for the last 1 year, it has generated negative returns and we still continue to hold. Any logics or any reasoning behind it?
So if you look at our exposure, we have reduced our exposure in this name. And this reduction is on the context of impact on their ROE. And so which is why the weight is way lower. We'll continue to monitor with respect to their execution. While loan growth has not been a problem, NIMs have been a challenge for them. So we'll continue to monitor it very closely and then take a call on the name.
We have Polycab in our portfolio. What was running in through in your minds during the IT rates crisis? The stock corrected, you held it. Can you expect? Can you elaborate a little bit more on the future stock of this future expectations on this stock?
So Rahul, I'll just correct you. This is a name we bought after the IT raid. In fact, we thought that there is enough of skepticism in this name. Earnings are on track. This earning, we could see real cash flows in the business, right? And we are investors who would really focus on cash flows. So after the impact on the stock price, we thought that this is a time to kind of get into this name. This is a beneficiary of the capex activity that's taking place. So significant capex in railways, significant capex on the roadside, significant capex in power. The largest player, not only is it largest, but it is still increasing market share at a pretty decent pace, have grown at one of the highest rate, in spite of it having 20% plus market share in its area. Their rate of growth was still one of the highest, or rather the highest, right? So we thought that that's an opportune time to kind of get into this thing. So if you look at our overall positioning on infrastructure, manufacturing driven businesses, not only we have Polycab, we have KEI as well, because we believe that both are quasi infrastructure play and with a relatively lesser volatility, will continue to grow 15 to 20% kind of rate for a length of time, and with a very decent ROC.
So with recently we have added a new stocks, which is Carborundum Universal and Adani Ports. Logic of adding these two stocks, if you can go stock wise, that will be great.
Sure. See, Adani Port, obviously it's a name which has a pretty high dominance in the port space in the country. And in fact, if you look at our exposure, we have both the ports in our portfolio. Right? We have Adani Port, we have JSW Infrastructure. We believe that with higher manufacturing in the country, EXIM will also get better. Right? Even inland transportation is inland water transportation will increase. Right? And these are names which, to our mind, have built one of the best assets in the country, and their profits are very rugged, and they have built a kind of annuity business already. While these are utilities, if you look at JSW Infrastructure, till about some time back before the acquisitions that they've done, their balance sheet was debt-free. While Adani may still have debt, but they are also, with the kind of cash flows that they are generating, that debt will come down pretty meaningfully. Right? So we thought it's a good time to increase allocation in both these names. So overall, this is more like 5 to 7% allocation in our portfolio, both these businesses put together. And if I talk about Carborundum Universal, it's a coincident play on the manufacturing space in the country. While we still don't have a very meaningful exposure in this area, but it's a company which is owned by Murugappa Group of South India, and they are very solid executors, very focused, and from corporate governance perspective, they kind of display very superior standards. So and if I look at the industry that they are in, it's a duopoly in the country, right? So manufacturing increasing will lead to positive impact on their business. In fact, over last few years, they have tried venturing into international arena as well. Time and again, the worries on one of their subsidiary, Russian subsidiary, the impact on that business actually worried investors, but their execution there has been very solid. Right. So, and stock hadn't done as well for some time. We thought business is changing course. Many of the impacts that they had in their business are kind of getting through. We should see at least 25% plus earnings growth from Carborundum from here on. And which is why as income growth or as profit growth was accelerating in a group which is very solid and an opportunity which is there for a length of time, we thought it an opportune time to get into the name.
Sumit, wanted to understand on why did we look at reducing weightages in banking and consumption-oriented segment? We believe that's a segment which can possibly move upwards, and there are many competitors launching a separate sectoral fund on the same space. Your thoughts on this part?
So see, if it's not that we are negative on the businesses that we may have sold. Fundamentally, very confident many of these businesses will keep delivering returns. Even though recent past may have been difficult for some of these businesses, they have pretty decent strength in their area of operations. But if we believe that manufacturing is here to stay from a long-term perspective, and government is also focused on kind of building infrastructure, and that will spur private capex as well. We thought we should have, and the businesses that we have invested into are execution masters in their own way. Right? So it is more to accommodate these businesses into the portfolio. We had to trim some weights in general. But specifically with respect to banks, we believe that overall, private sector banks may continue to face some bit of challenges. Their ROEs, given, I mean, those challenges involve challenges with respect to deposits. So overall, profit growth may remain subdued, and which is why we kind of pivoted towards relatively higher manufacturing.
Sumit, the portfolio doesn't have PSUs because the ownership has to be entrepreneurs. So we are missing a large basket of the rally which the market is seeing. And I believe last year the PSU funds have delivered anywhere between an 80% to 100%. What do you think as an investor somebody should look at this sector? Should he still continue to look at this sector? The first question. Second, how do we get into this segment which we are avoiding in IEP?
So see, you're right. IEP focuses on Indian promoter-owned businesses. And if you look at returns over long period, clearly Entrepreneur as a pack has delivered superior compounding returns. No doubt on that. Last few years have been a period where PSUs as a basket have really stand out. Their performance have been superlative, and the kind of divergence that we have seen are generally not seen, and which is why we are seeing relative impact on IEP portfolio. Right. Having said that, while PSUs will continue to perform, I have given the kind of improvement in those businesses that we have seen. We believe that our portfolios have become reasonably attractive from valuations front as well. Today, if you look at PE of the portfolio, it's close to about 25 FY26. So slight premium to benchmark, let's say about 25 to 30% premium over benchmark from a PE perspective. But this premium is actually backed by much superior earnings growth and significantly superior capital efficiency. So while we have had seen that impact, I believe that the incremental impact should be significantly lower. I believe the kind of divergence across ownership pattern that we have seen should not be visible henceforth.
Thank you, Sumit. We want to understand what steps are we taking in.
In fact, I would just add on to this. So see, if you know, we also have a lighthouse product we launched some time back, and this is a complementary product to IEP, I would say. Lighthouse is a product which would invest into few sectors at any point in time. While it's, I mean, in investing parlance, people still call it as business cycle fund. Having said that, while we are positive on Lighthouse, this can, and IEP both, Lighthouse actually can act as a complementary product to IEP. The portfolio difference is significant, and this can act as in an era where PSUs are doing reasonably all right, while in general remain very confident of how IEP would do on an absolute basis over a long period of time. But you know, when we look to compare this versus benchmark, promoter-owned businesses are close to about 55% of the benchmark. That's the playground, right? So when one compares it relatively, one may see divergences in the short period of time, but in isolation, really believe in the compounding capability of this portfolio to deliver returns.
Thank you, Sumit. What steps are we taking to see trying to better the gaps between the benchmarks that we have?
We intentionally don't want to induce any volatility into the portfolio. Historically, we have focused on high quality businesses where earnings compounding is superior. We have seen even in the past when there has been volatility, steadfast focus on right businesses into areas where we are confident of how earnings growth will play out. So pivoting towards businesses where we see that continued earnings delivery, I think that will allow us to be in good stead. Right? So, and which is why some changes in the portfolios have been done with respect to that. So in the past, if you look at our portfolios, we were very heavily tilted towards consumption. Now it's a balance between consumption, manufacturing, pharma, auto.
Sumit, we have a name Patanjali Foods still dragging in the portfolio. Your thoughts on the same?
So see, this is a name where we bought largely for their capability to create a foods business. Right? If you while overall revenue is reasonably large, but if I exclude even edible oil from their overall revenue pie, their foods business today is about 9,000 crore plus. It's a very sizable business that they've created. In fact, even at that size, they are still growing reasonably well. So we believe that as this group creates a very professional organization here, and they keep continuing onto their growth journey, backed by increasing product profile, increasing distribution depth, and that will lead to a superior cash flow compounding here as well. Right? And which is why this is part of the portfolio. And very recently, they have announced that they are considering some part of unlisted businesses to be merged into this business. We believe that given how their historical track record has been, that should also add value to the overall business. So we continue to remain positive on this name.
Right. Sumit, your thoughts on Varun Beverages?
So again, this is a company which is so most of our businesses, I can safely say, have done really well on the execution front, right? And this is no different. Over period, if you analyze their journey, they have become very integrated partner of Pepsi, gradually increasing their share in India and now becoming a very dominant player in Africa as well. Right. So we believe that Africa is going to be a growth geography for them, apart from India, which itself will grow really fast. So we see a very superior profit compounding for a length of time in this name. So which is why we have added this name into the portfolio. And this is owned by Ravi Jaipuria's based out of North India. And I would say they have continued to surprise us on execution. And now the kind of distribution network that they have built, it has become a cash flow machine.
Sumit, a constant question which keeps coming the last 2-3 years of underperformance has been a bit disappointing. What are the measures that you can induce to give confidence to investors on the forward-looking thought process of IEP as a portfolio or the return of the IEP?
So we just discussed, see, on an absolute basis, if you look at FY24, the absolute performance has been not bad, right? Relatively, we understand it is lagging a bit. We need to cover the lost ground. And our steadfast, I mean, if you look at our style as well, while style in general has remained the same, we have changed some businesses where we believe that profit compounding even in short period is very high. In fact, if you look at our style now, we now have reasonably or rather relatively lesser tolerance for businesses if the business performance is not as per expectation. So this is something that you would have seen and you would continue to see into the portfolio. So that is one change that we have brought about. Second is relatively some bit changes in the portfolio construct that we have brought about without diluting on quality, without diluting on growth, without diluting on ROC. That's the second change that we have brought about. Third is valuations have become a lot more reasonable of the portfolios at the current point in time. And these three things we believe should allow us to recoup the underperformance that we have seen. Our assessment is that we have also got impacted because of very sharp increase in interest rates that we've seen. And this kind of increase in interest rates impact is already in the valuations of those businesses which are relatively higher, so-called PE, right? I believe, as we just discussed, that possibly interest rates have peaked out. While we are not building in relatively lower interest rate for us to deliver alpha. If it gets, that will be an add-on. Our base case is, or when we believe that we'll deliver alpha, this is without assuming interest rates will go down. Even assuming that there is no impact of, or assuming that interest rates don't go up from here on, we should be fine from that perspective.
Thank you, Sumit. If banks ROE is a concern, then why are we still holding a few exposure in the banks? Why not reduce it more further?
We have reduced it meaningfully, and we'll keep closely watching out for that before we take any action.
We've been holding PI Industries, and it has been a drag in our portfolio, though it has created wealth in the earlier stages. Our thoughts on the same on PI Industries?
So yes, stock price has not performed, but business execution has consistently been better than estimates. In fact, we believe that the new molecules that they've launched over last few quarters, that should be the growth driver for them from here on. In the past, it has been largely one molecule which has been a growth driver. As business kind of diversifies itself, we remain hopeful that value creation will follow.
Government is focusing on railways and defense sector. Any thoughts on trying to add them on the private sector space?
Most of the beneficiaries here are PSUs, which is why if you look at our portfolios, we have indirect beneficiaries with respect to that, right? Whether it is cable companies, whether it is even the recent entrant may not have been an ideal weight so far still, but a name which is a consumable name, right? So we have tried playing it in that manner. Most of the beneficiaries directly are PSUs at the current point in time. But having said that, I believe that slowly this cycle will creep into private sector as well, right? And consequently, you will see consumable names also starting to do significantly better.
So have you tried playing that part in our existing IEP portfolio?
Yeah, right. So cable wire companies, consumables, even structural tube players, right? They benefit when infrastructure activity kinds of broad basis.
We still continue to hold IT as a sector, a single stock TCS. Any thoughts behind it?
So that's the only IT name in our portfolio. And we don't anticipate significantly higher returns. It's just that I believe those businesses will continue to compound while shorter term remains a challenge. Those businesses will continue to compound at close to about high single digit or low double digit in terms of their revenue growth. Rupee will depreciate marginally, so that will add on to their revenue growth, and almost slightly better profit growth and that kind of value creation over a long period of time. And they act as a would act as a good stabilizer if currency for whatever reason starts to have some impact, right? So which is why significantly lower positioning though, and the only name, and looking at it very closely, that is that the ideal weight or should we have a relatively lower weight in this name?
Is there a targeted delta that you have a mind to beat the bench over the benchmark that you intend to have between 24-25 financial year?
See, Obviously, there is an expectation of delta from the portfolio, right? And a reasonable one though. But Mr. Markets are Mr. Markets, right? They always act in a very, very non-linear fashion. So I would refrain from putting out a number on the platform.
So our IEP benchmark is BSE 500. Should it not be focused on getting the benchmark changed to a better place as such? Because you predominantly have a lot of large cap in your portfolio.
So see, while if you analyze performance of different indices, whether it is large, whether it is mid, or whether it is small, on a 10-year rolling basis, until 2 years back, the 10-year rolling performances of large, mid, and small actually was not very different. So over a long period, I remain reasonably confident of beating or doing I mean, because of the kind of businesses that we own, because of the earnings growth that those businesses should deliver, remain reasonably confident whether it is Nifty or whether it is BSE 500. We should do better than both these indices. I mean, just that, as we discussed, one ownership pattern performs so well, right? That, I mean, if you think about PSUs itself, last year average was about 10-11%. Right now, it's about 13% in BSE 500. And that average PSUs have delivered about 80%, 85% return, right? So 8% contribution to returns of BSE 500 has been by PSUs, and which is why we are seeing this divergence. I believe that phase is behind where we would see this kind of divergence. Valuations, as we talked about, on PSUs are more palatable now. And to that extent, we should see all the ownership pattern kind of delivering returns.
Is there a intent to change, to chase momentum to cover up the gap of the benchmark?
We will not get into momentum for the sake of momentum. Only when that business has a merit, only when we believe that we can expect compounding returns there, we would get into that business. We would not dilute quality because it's vital, right? Because our investing style actually has been, we always believe that when we buy a superior business, even though when that is bought at a fair price, that's a much superior proposition than buying inferior one, when even though that may be available at very attractive prices, right? Last few years have been different though, but buying a superior business has its own merit because world is uncertain, right? The ability of a superior business to tackle the uncertainties is way superior as compared to that of the other ones, right? We need to build all season portfolio, and we need to give compounding returns to our investors.
Sumit, a lot of questions again are coming on the performance side. We still want you to go a little deeper on what actually were the damages. So one question was, did we exit Dixon at a wrong time? So if you could possibly answer that, and then I'll run through the next question.
So, obviously in hindsight, it looks to be a decision which should not have been taken. Right? After we exited, the stock has rather performed very well in the marketplace. Obviously, there was a merit in investing in Dixon at the first place because size of opportunity for that company is large. And they were, or they are, the largest player in this arena. Right? You know, after we got into this name, they had a series of bad performances. Right? Their business performance was not up to mark for a length of time. And consequently, we had to kind of exit that name. And after we exited that name, there were furthermore PLIs which benefited that company. Right? So obviously, as I talked about, our businesses, you would see them going to new highs uh, eventually, but at this rapid pace, we didn't think so. So to that extent, we exited when we didn't see the performance, and we, in hindsight, this looks to be a decision which wherein we should not have kind of done that. Having said that, in that context, we bought into other names, may not have performed the way Dixon has performed, but still would have kind of performed into the portfolio.
Somebody who's invested in 2019, he's possibly made closer to double, but seeing the market returns, he feels he's missed out on the rally. How do you believe? What confidence measures would you possibly give him to stay put in the portfolio where he can reap rewards going forward?
So see, we are discussing this at a point where markets have had a great run. Right? I think when we analyze our own performance across cycle, when there is a good cycle, when there is a bad cycle, right, as well, very confident how our portfolios will kind of play out versus the benchmark as well. And while 2019 onwards, it has been a one-way run, and which is why we need to look at our performance from that perspective. Having said that, I believe changes have been made into the portfolio, and we remain confident of how it will play out.
We have a few names in the semiconductor play. Any thoughts on them, which could be against technology, Dynamatic, Zen Technologies, Moschip? Anything on those lines that we intend to play on with the semiconductor part?
So it's not only about semicon. In fact, there are a lot of industries which will do well, right? So see, what are the areas where government is focused on, or there is energy transition that will do well. And, you know, if you look at power infrastructure world over, that's in a bad shape, right? So I think manufacturing in India, in general, it's not only about semicon, but in general will do well, and we'll keep focusing on this area in our portfolio. You're right, when semicon does well, the names that you talked about will do well, but that's not the entire part. Power infrastructure will also do well. EV transitioning, again, will do well. Green energy, hydrogen ecosystem, those are also the areas that will do well. And those are areas which are more sunrise areas. And over period, you will see a lot of entrepreneurs here actually coming into the fore big time. And I think you will see some or the other areas here into our portfolio.
Does any of these stocks currently fit into our measurable filters of ROC and earnings growth?
Many of these are significantly smaller with low liquidity into the marketplace. And if you look at our portfolios, we have always been very mindful of liquidity profile in the portfolio as well, because we believe that investing is, I mean, we need to deliver returns and being very mindful of the risk as well that we are taking. Liquidity plays a very important role, right? And the names that you talked about would be relatively more illiquid. And Also, liquidity is very cyclical. Today, uh, these names would be relatively more liquid. As we see time passing by, those businesses which execute well will see liquidity keep coming into the name, and those businesses that don't deliver will actually see liquidity drying up. Right?
Sumit, we had Geo Finance in our portfolio, which we exited, and it has again close to doubled as a stock. Did we miss the rally there, or what was our intent to get out of that stock?
That was a small position in our portfolio. We got it from because we have ownership in Reliance, and we got it from there. We wanted to first see how they really execute before we kind of take a call on that name. Obviously, opportunities for them are many, but what are the areas where they would be significantly bigger? We would kind of really look for that before we take any actions there.
Sumit, your at this point of time, I don't have many other questions coming in. Your thoughts, your closing thoughts in terms of how long a client should possibly wait to see a possibility of an alpha beating the benchmark and looking him towards a positive traction of seeing a 16-18% return on his portfolio.
Without getting into individual numbers, see now, I think from this year onwards itself, I believe the divergence in earnings compounding for Nifty, and why I'm taking Nifty while BSE 500 may be the benchmark, but because that's available in terms of estimates, and that is where people keep kind of putting in numbers for BSE 500 that may not be entirely available. So, and I don't see a huge divergence between BSE 500 earnings and Nifty 50 earnings in FY25. Having said that, now this year onwards, we believe the earnings gap is widening again. As we discussed, Nifty 50 should deliver 13 to 15% earnings compounding, while ours should be 25% this year and 20% next year, right? So, as this earnings divergence is widening with relatively better valuations as compared to what they were in the past. If you look at markets, they are sitting at a point where valuations are relatively premium versus what they used to be in the past. Here, valuations are at discount to what they used to be in the past, right? With continued earnings compounding. So, which is why I think the cycle should turn.
Sumit, the question, are there any companies which focuses on drone, and are we participating in any on that segment or allied?
So there are companies, including Adani Group as well, who is focusing on drone. There are companies which are focusing on drone, but all of them today are significantly smaller in size, right, to really participate in that area at the current point in time. Having said that, in some of our other portfolios, for example, in growth portfolio, we do own a company which is a company by the name Solar Industries, who have invested into a drone manufacturing company. Similarly, there are other businesses of Murugappa Group, not the one that we have invested into, but there are some businesses of Murugappa Group who are investing into drone manufacturing. Right. So that's where it stands at the current point in time.
That's all, Sumit. Any other questions that you have? Please type in the Q&A answer segment, so which will enable us to reach out to Sumit. Sumit, Asian Paints is part of our portfolio. What's the plan of Asian Paints? It has been a laggard for the last 1.5 years.
It's a position which is significantly smaller at the current point in time. It's about 1.5, less than 1.5% of the portfolio. Asian Paints has a strength, no doubt. At the current point, the competitive intensity has increased, but do they have capability to deliver double-digit volume growth in spite of this increase in competitive intensity? We really think so. In fact, if you look at what they've done over last 1 year to take on this competition, also is they've increased their penetration significantly more. For example, they've recently increased the retail count by 10,000 itself, right, on a base of roughly about 1.5, 1.6 lakhs, right? So to that extent, they have gone a lot deeper, become a lot more aggressive, right? We'll keep a very close eye on how this competitive intensity is playing out. And paints is not an easy business. Penetrating here into the distribution network is a challenge, right? Because installing those tinting machine is something that into the retail channel does takes a lot of time. And if I look at how have new entrants in the past performed, those have performed rather poorly. Many multinationals tried entering this arena, but they have actually not been very successful here. So to that extent, we'll keep a very close eye on how this competitive intensity plays out, and then we'll take a call there. But suffice it to say, a very small exposure versus what it used to be in the past.
What do you anticipate in terms of FIIs putting in money post the election result? What gives you the confidence that FIIs would possibly put in money?
It's not about election results necessarily. I think what they need is continuity of policy, stability of policy, ease of doing business. And I think this is what is expected, right? And which is why I believe that given the kind of long period compounding India can offer, think about it like this: over last 10 years, Indian markets have been one of the best performing markets, apart from, I mean, India and US share the top 2 positioning in returns in dollar terms. This kind of returns have been delivered in an era where rupee depreciated close to about close to about 4% or thereabouts, right? I believe over next many years, the rate of rupee depreciation will be lower than what we have seen over last 10 years. So the impact on their returns should be lower. Also, if India's overall GDP ranking keep getting better, India's share in world allocation can't be so low. So, which is why I believe allocation of FII in India will be higher. Allocation of domestic institutional investors will also be higher into the country. Keep ignoring shorter term nuances there.
Sumit, thoughts on Metropolis, which is still a very small part in our portfolio?
See, over last 1 year, it has delivered 50% plus returns, right? Over last 1 year, what has happened in this industry? Initially, competitive intensity increased pretty dramatically, much like what we are seeing in paints, but entry barriers are very high. At the current juncture, what we are seeing is competitive intensity has reduced dramatically. Players like Metropolis have actually raised prices. So what's happening is over period, we will see uh, them reporting uh, anywhere between 13 to 15% revenue growth with improvement in margins. It was a perfect storm we discussed some time back that volumes were impacted, pricing was impacted, and they were kind of getting deeper, and which is why that had an implication on their cost structure. At the current juncture, volumes have improved, pricing have improved, and the impact of a deeper penetration in terms of cost structure is already in the base, right? So which is why we should see improvement in margins as well from Metropolis from here on. Having said that, it's a small position, and you would appreciate generally our style has not been to keep small positions into the portfolio, either scale up or exit, right? Because we believe that we don't believe in building big tails.
Could we see adding more engineering names in our portfolio, trying to beat the benchmark weightages?
No, it's not about beating benchmark or our philosophy is to invest into businesses where which we really believe that those offers value. And clearly, this space, I think entire manufacturing is seeing traction after a long time. And you know, unlike services, uh, creating manufacturing ecosystem takes significantly longer period of time. Today, we are at a point where um, many of these pieces are falling in place. And consequently, a lot of new opportunities, a lot of new businesses here as well will evolve. As we discussed, at the current juncture, this has been driven by public, and which is why we've seen this kind of interest there. But we really believe slowly it will percolate to private side as well.
Anything specific that made us to exit out of Page Industries?
So, you know, business performance continues to remain a challenge, while very confident that they will come back. Business has been challenged more with respect to how industry growth also has played out. So, but really believe they will come back. But having what in terms of intervention we have brought into the portfolio is relatively lesser tolerance with respect to the underperformance on business front. So we may have exited today, but if we really believe that things alter very meaningfully, business has strength. If business traction alters meaningfully, we'll look at it again.
So, what is the condition that we possibly look at while exiting a stock? There are a few stocks which have underperformed for a long period of time, which is an AU Small Finance Bank or a Patanjali or a TCS, to add a few names. What do we look at while exiting?
So see,
for how long do we wait to exit out of a stock?
Yeah, you know, first and foremost, we get worried if business is losing market share. That's a very important metric. In fact, our businesses should have ability to maintain or improve market share and yet not have a very significant impact on their ROC. And if we believe that that industry will is a secular one and should eventually come back to growth, those businesses actually will bounce back pretty meaningfully. So that's a very important metric when we look at any business. Right. So to that extent, not many businesses actually have lost market share in our portfolios, right? Having said that, as we discussed, we see opportunity in many pockets in the marketplace. And if you think about when do we kind of trim or exit, is when we believe that there are relatively more opportunities in the marketplace. One. Second, if we need to increase allocation of something where we have a relatively lower weight, and we believe that this business is not performing as well, and consequently value creation here would be lower than the one that I am kind of increasing weight. Second. Or third, if business itself is not performing the way I had envisaged. Right? So these are the reasons where we kind of need to alter our positioning.
And how long do we take time to alter the position? Is it done swiftly, or do we take our time to exit out of a business?
So that's I mean, really difficult to answer this in terms of timelines. But in the past, we were relatively more patient. Each of these businesses have strength. Today, opportunities are relatively more. So to that extent, relative patience is lower.
A question which comes for tomorrow: what if the current government doesn't come back with the policies changing? What thought process or what strategy you have in mind for the portfolio?
So you are saying if this government doesn't come to power?
That's one of the questions which comes in. What if the current government lose election?
Yeah. Interestingly, I don't think immediately many would have an opportunity to even get out. Right? That's a possibility, right? So, while given how exit polls have also played out, I would not even put that as a base case scenario at the current point in time. But if that really plays out, I think markets in general will see a very sharp impact. Will we? I mean, but it's not a great statement to say. But will we do better than the markets? I would think so. Right. Given the fact that our investment into any business is not basis some or it is actually basis how and what are the strength of the management and how does the opportunity look like. Some opportunities may alter versus our current assessment. For example, areas with respect to manufacturing, areas with respect to infrastructure build out, it may not play out the way we are envisaging at the current point in time. So we'll have to take appropriate steps at that point in time.
I mean, do you expect a correction in the markets?
In markets like India, or in any markets for that matter in equity, corrections can come in at any point in time. If they come, those should be used as an opportunity to add on into the markets, right? And given the kind of run that we have already seen, it's very much possible. But our assessment is not taking into account shorter term factors. We would look for where are corporate earnings headed, and that's the way we would like to play this game.
That's all, Sumit. I don't have any other questions on the screen. Any final questions that you have?
No more questions?
No more questions, Sumit.
Sure.
Thank you so much.
Great. Thank you. Thank you everyone for joining in. We understand performance is trailing benchmark, while on an absolute basis, it's still all right on a fiscal year 24 basis. But we remain confident on the underlying business performances. We remain confident of our processes. and consequently, we should recover back. Thank you. Rahul, is it?
Yes.
Sure. Okay.
Yeah.
Thanks a lot.
Thank you.